Hello and welcome to the Federal Home Loan Bank of Boston Insurance Company Funding Strategy webinar. We're pleased that you have joined us today, and whether you are looking at membership for the first time or have been a long-time member, we feel you will benefit from today's discussion. We will start with a quick overview of the bank and then spend the bulk of the next 35 minutes on ways to leverage FHLB membership. Let me start by introducing myself. My name is Matt Stewart, and I am responsible for the insurance company sector at the bank. Prior to this role, I held various positions at both Prudential and Liberty Mutual. I'm very pleased to be joined by Bob Albans, who is a principal at Montshire Advisors. I've had the pleasure of working with Bob the last few years and have seen firsthand the outstanding work that they do at Montshire. I'll ask Bob to provide a couple comments on his background.
Thanks, Matt. Montshire was formed about 4 years ago to advise life insurers on reinsurance, corporate-owned life insurance programs, Federal Home Loan Bank programs, as well as product and distribution opportunities. Over the past 4 years at Montshire, I've advised several insurance companies on joining the Federal Home Loan Bank and also implementing spread-based borrowing programs. Prior to Montshire, I headed up corporate development at a couple insurance companies, including National Life of Vermont, where we joined the Federal Home Loan Bank and implemented a spread-based borrowing program.
Let's jump right in and talk about the Federal Home Loan Bank. The bank system was created during the Depression to provide funding to financial institutions. Today, there are 11 banks that are all independent and structured as a co-op, owned by the member institutions. Through its Office of Finance, the banks are able to raise low-cost funding due to its size and government-sponsored enterprise status. The 11 banks then make that money available to its member institutions. The banks are regulated by the Federal Housing Finance Agency, the same agency that regulates Fannie and Freddie Mac. The banks are well capitalized and have performed very well in all economic cycles, including the recent recession. For example, during the 2008 time period, the amount of bank lending more than doubled as most other sources of liquidity dried up. Bob, let's summarize the benefits of being an FHLB member. In the previous slide, I mentioned how borrowing significantly increased in 2008 during the Great Global Recession. I would suggest the biggest benefit is knowing that the bank is designed to provide liquidity and, since 1932, has always been able to support its members. It is extremely reliable, as you know. This was evident again at the outset of the COVID-19 shutdowns. The amount of borrowing by insurance companies increased by 23% in a short period of time. For many, this was the only source of funding until the markets were stabilized. Another benefit, obviously due to the size of the FHLB system and its status as a government-sponsored enterprise, the bank is able to raise funds at a low cost and pass it on to the members. Other benefits include the ease of accessing funds, the financial flexibility it provides, and we can jump in a little more about rating agencies and regulators in the next slide. We all know that an insurance company's rating is very important and should be carefully considered. As such, how do the rating agencies look at FHLB membership? As evidenced on the screen, from the excerpts from the rating agencies, you will find that they look very favorably upon it.
Matt, let me interject here that agencies generally view Federal Home Loan Bank membership positively since it provides a consistent and low-cost source of liquidity. Generally, the rating agencies view spread-based borrowing by insurance companies as acceptable up to a threshold level that is not viewed as excessive.
In this slide, you see the significant increase in number of insurance companies that are FHLB members. At the end of 2019, there were almost 500 companies. And this number will likely continue to rise as more insurance leaders learn about the value of FHLB membership.
Matt, I would add, of the insurers that we talk to who are currently members, many of them are looking at ways to increase their usage of the Federal Home Loan Bank. And of the insurers who we talk to that are not currently members, many of them are looking at joining the Federal Home Loan Bank. So I don't see this trend changing anytime soon.
Here are the current insurance company members in the Boston Bank. You'll see that various insurance sectors are represented. You have life, P&C, health, title, risk retention groups, and depositors insurance. In addition, the size of the companies vary greatly from smaller regionals to some of the largest in the world. The membership requirements for an insurance company is that it is duly organized and regulated by a state, holds residential mortgage-related assets, and is financially sound. The insurance company would be a member of the FHLB Bank that covers the territory where the company is principally located. The application process is fairly easy and includes completing an application and submitting some standard reports and documents.
Matt, what are you seeing in terms of prospective new members joining the Federal Home Loan Bank?
It's a good question, Bob. We have quite a healthy pipeline of companies that we're talking to that are very interested in joining the bank. So how does the bank membership work? As previously mentioned, the members own the bank, and as such, upon becoming a member, the insurance company will purchase membership stock. This membership stock is calculated by multiplying the amount of U.S. Treasuries and agencies along with residential mortgage-related assets that are on the member's balance sheet by 20 basis points. This number is updated annually and can go up or down depending on the member's portfolio. This stock is eligible to receive a dividend, and as of July 2020, the Boston FHLB Bank dividend rate was 3 months LIBOR plus 350 basis points. Upon borrowing, the member will also purchase activity stock of either 3 or 4% of the borrowed amount. Similar to membership stock, the activity stock also receives the same dividend. And once the loan is paid back, the activity stock becomes excess and is eligible to be repurchased. Before a member borrows, they will pledge collateral. The amount after haircuts will need to be equal to or greater than the desired borrowing amount. The eligible collateral types include U.S.-backed securities such as Treasuries, Small Business Administration. It also includes agency securities. It includes residential and commercial mortgage-backed securities, municipal securities that have a real estate nexus, and it includes loans that includes residential, multifamily, or commercial mortgages. Once the collateral is in the custodian account, the member can easily borrow with one phone call or a click of the mouse. As for the bank products, the Boston FHLB offers a wide variety. Loans, also known as advances, can be overnight to 20 years in term. They can have a fixed or floating rate. They can be a bullet or amortizing, and can have embedded derivatives such as floors, caps, or options. Overnight funds are available same day up until 5 p.m., while term products are available same day up until noon. The process is very easy and only requires one phone call or one internet transaction. Bob, besides advances, the bank offers low-cost letters of credits. These letters of credits can be used for a variety of reasons, and the Boston Bank is NAIC approved, which makes it easy for an insurance company to utilize this. Finally, the bank also has several housing and community investment products that are used by insurance companies. These products include subsidized rates and outright grants that many take advantage of. Now to discuss how members best utilize their membership, let me turn it over to Bob. Bob?
Thanks, Matt. Insurance companies can use their Federal Home Loan Bank membership for a variety of purposes. For contingent liquidity, insurers can utilize the Federal Home Loan Bank for cash management and take advantage of the Federal Home Loan Bank's very inexpensive short-term rates. Insurers can utilize the Federal Home Loan Bank for liquidity to manage shorter duration liabilities, which can provide the ability for an insurer to redeploy some assets into higher yielding, longer duration investments. Insurers can utilize Federal Home Loan Bank as emergency liquidity in times of market stress when it may be difficult to obtain liquidity elsewhere. And liquidity can be created for otherwise illiquid investments such as commercial or residential mortgages. For asset and liability management, many insurers are interested in spread-based borrowing programs with the Federal Home Loan Bank, which we will go into a bit more detail about further on in the presentation. Insurers can also utilize their Federal Home Loan Bank advance capacity to purchase assets when there are market opportunities, rather than being limited to buying assets only when cash is available. Insurers can utilize Federal Home Loan Bank products to manage their interest rate risk, extend or shorten liability duration to target an optimal point on the interest rate curve, and manage through any unexpected cash flow needs, such as those caused by unexpected policyholder behavior or claims events. For special events, insurers can access community development programs and access grants and subsidized borrowing rates. And one insurer borrowed money for an acquisition and utilized the Federal Home Loan Bank advance to partially fund an acquisition. Insurers can fund share buybacks, debt repurchases, or other corporate restructuring activity. And as Matt mentioned earlier, the Federal Home Loan Bank of Boston has a NAIC-approved form of letter of credit, which could be helpful for certain reinsurance transactions. So Matt, as you can see, there are numerous ways an insurer can utilize their Federal Home Loan Bank membership.
When you're considering a spread-based borrowing program, what are the typical things you should consider? First, you should think about the targeted spread. The spread is the difference between the advance cost and the return of the invested assets that are purchased with the proceeds from the advance. The targeted spread required depends on your capital requirements, which vary depending on which capital model you use, whether it's RBC, AM Best, or S&P, and what your targeted return is on capital. The spread amount is the amount that's required to achieve that amount of return on capital. Next, you need to consider what investments are out there that can achieve that amount of spread, and do they fit with the company's risk and return objectives. This obviously varies over time. For example, at one point in time, investment-grade bonds might achieve an attractive spread, and at other times they may not. Also, with regard to timing, not only is the timing of when attractive investment opportunity is important, but also when the company has excess capital available. An FHLB spread-based borrowing program affords the flexibility of expanding the program when there is excess capital available and contracting it when capital is needed for other lines of business. Finally, as Matt went through the product categories available, I think it emphasized the degree of flexibility that exists in structuring a Federal Home Loan Bank's spread-based borrowing program. With this program, you need to reverse the typical order of thinking. That is, typically we start with a liability and then we look for a mix of assets that match that liability. With this program, it's better to start with the asset. What assets are available that provide attractive returns relative to risk, and then design the advance to match the asset. On the next slide, we're going to see an illustrative example of a spread-based borrowing program. In this example, we illustrate the return on capital for a life insurer entering into a $100 million 5-year funding agreement with the Federal Home Loan Bank and investing the proceeds in a portfolio of 50% A-rated corporate bonds and 50% BBB rated corporate bonds. We illustrate the capital requirements under RBC, S&P, and AM Best BCAR capital models, including the charges for C0 for pledge collateral, C1 other for the bond asset risk charge, C1 CS for the capital required for the activity stock purchased. There is no C2 or C4 capital, but the C3, there's a C3 interest rate charge. The advance costs that we're illustrating is 180 basis points, and the spread on the investments, or the yield on the investments, is 300 basis points, generating 120 basis points of net spread. Assuming a 35% tax rate, this would generate about 80 basis points of after-tax spread, which would result in a return on capital of between 12.7 and 18.6%, depending on whether we're focused on the RBC, S&P, or BCAR capital model. The spread-based borrowing is not only available to life insurers, but also to P&C and health insurers, and those companies would have similar capital requirements.
now let's talk about the optimal investments to put into the Federal Home Loan Bank program. In the prior example, we used a blend of A-rated and BBB rated corporate bonds, but let's talk about all of the potential universe of assets that may make sense for a spread-based borrowing program. So one of the first things that you should think about as a member that's looking to implement a spread-based borrowing program is whether the assets that you're going to invest in you're also planning to pledge as collateral to the Federal Home Loan Bank. And so if you're a large insurance company with a big balance sheet, it's likely that you have substantial amounts of FHLB eligible assets on your balance sheet currently, and therefore you have a significant amount of borrowing capacity, and therefore you will not be constrained. You would not be constrained to invest solely in those asset classes. You could invest in other asset classes and use the eligible collateral that's already on your balance sheet to pledge as collateral for your program. But if you're a smaller insurance company that doesn't have a significant amount of borrowing capacity and doesn't have a significant amount of eligible collateral on their balance sheet, then you're going to be more focused on finding those assets that you can invest in that can produce an attractive return, but that are also eligible. They themselves are also eligible collateral for the Federal Home Loan Bank. And so on the left side, we name some of those asset classes. From time to time, the rates and spreads can vary, but AAA down to A-rated CMBS, fixed or floating rate commercial mortgage loans, investor-owned residential mortgage loans, jumbo residential mortgage loans, sometimes even agency RMBS, and synthetics. Synthetics being the synthetic generation of a replication of another asset. So essentially pairing a treasury with a derivative to replicate a corporate bond or a principal protected note or some other asset. The underlying treasury can then be eligible collateral for the Federal Home Loan Bank program. And then for those that are not constrained to pledge assets that are part of the spread-based borrowing program, they may look more broadly into other asset classes that could include the investment-grade corporates. Typically, you're going to be looking at A down to BBB, and CLOs, non-agency RMBS, ABS, and then some more exotic opportunities like structured settlements, lottery settlements, emerging market, inflation-linked sovereigns, principal protected notes, rated funds. So Matt, let's take a look at how a typical 5-year Federal Home Loan Bank advance compares with 5-year Treasury rates. As you can see in this chart, going back to 1999 up to current, there's a very high correlation between the Federal Home Loan Bank 5-year fixed rate advance and 5-year Treasuries. The median spread between the advance rate and Treasuries has been 61 basis points over that period, and currently it's about 55 basis points. And then we look at, from a timing perspective, which assets work and when do they work. And so in this chart, we're showing the A-rated corporate bond spread to Federal Home Loan Bank advances and the BBB corporate spread to Federal Home Loan Bank advance rate over time, going back to 1999 up to current. And you can see that the A corporate credit spread to Federal Home Loan Bank advance has been anywhere from -8 to +478. So there is a timing element here of if you put on your program at when the conditions are optimal, you can lock in a very attractive spread. And the median for the A corporate credit spread was 62 basis points. Back in the beginning of May was about 75 basis points. And then the BBB corporate credit spread has ranged from 49 to 623 with a median of 138 basis points. And the beginning of May was about 175 basis points. AAA CMBS spreads, median about 50 basis points, recently around 75. Commercial mortgage whole loans, median about 100 basis points, currently about 125 basis points. And AAA CLO spread, the median was 75 basis points. Recently it was as much as 150 basis points, so that would seem to be a fairly attractive opportunity. So we're going to shift gears now and talk about cash management. And this example will use a health or a P&C insurer. And as we mentioned before, health and P&C insurers tend to hold on to cash and short-term investments more so than their life insurance brethren. And across the industry, the average cash plus bonds maturing in less than 1 year as a percentage of total invested assets is approximately 12 and 30% respectively for P&C and health companies. So a pretty significant amount of cash and bonds. In the current interest rate environment, those assets are earning very, very small amounts. And so in this example, we illustrate reallocating a portion of the cash and short-term bonds to higher yielding investments and then relying on the Federal Home Loan Bank for cash management. And so in this example, we have an insurer that has $75 million of cash, and we take half of the cash and allocate that to higher yielding investments, assuming that the yield increases from 50 basis points to 300 basis points. And so the insurer, which had $20 million of net income, now is generating $20.6 million of net income. And their ROE has improved by 0.2% and their ROA by 0.1%. So not in and of itself doesn't sound like a huge amount, but obviously if it was a larger insurer, these amounts would scale up. And you're talking about a 3% increase in net income, probably something that many insurers might want to look at doing, and considering that this is something that is well within their control.
Bob, let me apply some actual dollar amounts. Today's overnight rate is 46 basis points, and so if I borrow $1 million, I'm only paying $12.70 for that. And recognizing that 46 basis points is on the low end, even if you double it, you're looking at $25 for a cost of $1 million. And even if you go to 2% for the overnight, it's $55. So as you can see, it's financially attractive to use the bank for cash management. And the other large benefit is the convenience. The funding for overnight is available right up until 5 o'clock. So if it's late in the day and you realize you need cash, it's an easy call to obtain that. So Bob, at this point, maybe I ask you a couple questions. And you're out there with a lot of insurance companies, talking to them on a variety of issues related to this. What advice would you give to a company who's thinking about joining the FHLB?
Well, Matt, as we went through this presentation, I think we demonstrated that there are a number of benefits to insurers to joining the Federal Home Loan Bank. And so I would say that there's something in it for virtually everyone, every insurer. And so I would say that if you haven't joined already, that you should strongly consider getting it into your priorities to start the process.
I agree with you, Bob, 100%. Now, what if you were an existing member and you really haven't done much with it? What advice would you suggest to these companies?
Well, I would think about the different programs that we talked about, the different ways to use the Federal Home Loan Bank, and I would, for companies that haven't implemented spread-based borrowing, I would encourage them to think about whether or not it might make sense for them. And in particular, I would point out the tremendous flexibility of the advanced structures, and that basically if you include a prepayment option in the structure, the insurer has control of when to put it on and when to take it off. And so that can really be a great tool for an insurance company to manage their earnings. And so I think that is something that more insurance companies should avail themselves of.
Great suggestion, Bob. So at this point, I want to thank everybody for listening in and wish you all well and take care.